Broadcast is now starting. All attendees are in listen-only mode.
Welcome to our 2019 webinar series. Our 2019 monthly webinars will include client stories, your clients' stories, and how those stories can help you and other clients in this year and beyond. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We'll answer all questions at the end of the webinar. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. And throughout 2019, loyal fans will receive 10 CFP CE credits, one for each month. Today's presenter is constantly monitoring the changes in annuities and hybrid insurance combos to ensure your clients are getting the most up-to-date solutions. He joined LLIS in 2008 and has over 20 years analyzing, studying, and researching annuity solutions. Here to share all his knowledge on annuities is Jerry Skapiak.
Thank you, Claudia. So today we're going to talk about your clients' use of annuities in retirement. And your clients are coming to you with the goal of helping them get to retirement and through retirement. So it takes a lot of planning, all geared towards getting them to those points in their lives. But when you look at how long retirement is, it's kind of like a lot of your clients are going to look at it as it's 35 years of unemployment. They've been told to save their whole lives. And then when they get into retirement, now they're told it's okay to spend that money now. So clients have hard times making that transitions. And so that's where annuities can kind of step in and help with that, provide some guaranteed income to your clients. So when your clients are thinking about retirement, 76% of them are stressed out about it. Just even talking about it stresses them out because they're unsure of, are they going to be able to make it through retirement? Are they going to have enough money? Are they going to have to change their spending habits? All questions that you are there to help them with and to get over those hurdles that they're having. This one is truly amazing to me. 45% of Americans have saved nothing for retirement. Now, granted, this is not your clients, but it's just a problem in America that people are not retiring or saving for retirement and are going to be solely dependent on Social Security. 22% of workers are confident they have saved enough for retirement. So that's a good thing. And this is where I kind of feel more of your clients are falling into, is in this 22%, because they are working with you. They have been saving. You've been guiding them all along. So the road to retirement. So let's take a look at how annuities, help this road, help calm your clients' nerves, make them feel more at ease when entering retirement. So what we're going to do today is we're going to look at income riders on annuities. This is always a very popular subject because a lot of your clients that have annuities, not that you recommended they get it, they come to you with them, don't understand them, but they can be valuable to them since they already have them. We're going to take a look at fixed deferred annuities. We're also going to touch base on immediate annuities, which is my favorite annuity, especially for when we're looking for income in retirement. QLACs, it's one of the newest annuity products that are out there and can be beneficial to some of your clients. And then we're also going to look at claims. I get questions all the time, my client, parent, father or mother, whoever just passed away, they had an annuity, what are their options? So we're going to talk about that a little bit. So first, I want to talk about income riders. So here we have Nancy, and this was actually a friend of Judith Maurer. Her daughter had died in a tragic accident. Nancy was the beneficiary of the life insurance policy, so she had a bit of money, and she invested that money wisely over the years. Um, but it was the only money she had, and she was afraid of losing it to market turmoil. She didn't need the money now, but she was going to use the money for income in the future. So what we did for Nancy is we took a look at an annuity for her that had an income rider. So this is a statement back from 2014. I like using this one because we got a lot of ups in the market and not so many ups in it over the history of it. So this is very common of what I'll see when I'm looking at a statement. So I just want to kind of go through this as you have clients come in with statements. This may help you dissect them a little bit more. The first thing we're going to see here is a policy number. Actually, that means absolutely nothing to me. There's nothing I can do with that. We have policy issue date. Very important to know that. One, it's going to tell me how old that annuity is, and then two, when will surrender charges be over if there are any. Owner's name, who owns it, annuitant, if it's a joint annuity, where we got two annuitants, so we'll have a second annuitant here. Also very important, is annuity qualified or non-qualified? And then this statement calls it plan type. It says no load annuity. That's actually the name of the annuity. But they're generally going to have the actual marketing name of the annuity. And that's what I'm able to take and look up information on your client's annuity. I got to have that marketing name. Then we start getting into the meat of the statement. What are the policy values as of the date? Contributions, have they made any additional contributions into the annuity? Is always very helpful to have. Withdrawals, have they taken any money? As we can see here, Nancy did take out $46,507 out of the annuity in this past year of this statement. Charges, so these charges are going to refer to any riders on the annuity. So she does have a rider. She has a guaranteed lifetime withdrawal benefit rider on this annuity, and it's costing her, almost $4,000 a quarter to have that rider on the annuity. Gain loss on the annuity is pretty much self-explanatory. And then their policy value as of the date of the statement. Now down here, net deposits since inception. You take a look at that number, $612,202.28. Whenever I see a statement and it has odd numbers on it, odd, I mean anything other than like 600,000, 650,000, 500,000, 100,000, 125,000. When I start seeing odd numbers, $122,343, that's going to tell me that that annuity was funded with another annuity, meaning a 1035 exchange was done into that annuity. Now, as I said, this came from a life insurance proceeds. It was, she had some investments, so she rolled a large part of it in here. So this is kind of a unique situation in this case. But most of the time, if it's going to be new money a client put into an annuity, it's going to have round numbers, $100,000, $50,000. Very common to see that as like the initial premium put into an annuity. When we see odd numbers, more than likely it came from somewhere else. And that also tells me I can't tell what the cost basis is of the annuity. And sometimes some of these your older clients, they may have had an annuity for many, many years and have done many transfers. If that cost basis hasn't been transferred all along, it gets lost. And the current insurance company will record the cost basis like as $1 or even a penny. And then unfortunately, it's really up for the client to backtrack and find where that cost basis was lost and where it wasn't transferred. And then they got to kind of work forward with the insurance companies. We'll have that cost basis transferred to company A, then transferred to company B to finally get it to their current annuity. But the meat of this is this guaranteed lifetime withdrawal benefit. This is why the annuity was really purchased for her, because she was planning on using the annuity for income. We're going to take a look at it. Benefit base, and we're going to go over this in a little bit more detail on the next couple of slides. But benefit base, that's the value of the rider. You'll notice it's different than the policy value. Policy value is $968,000. This is $982,000. So the value of the rider is more than the actual value of the annuity. This is what's called in the money, meaning that it's worth more. Next, we're seeing annual GLWB amount. That's how much she'll be able to take out of the annuity each year. Last step update, none. We're going to go over what step update means in a minute. Withdrawals taken out this year, she's taken out $9,000. She hasn't taken out any excess withdrawals, meaning she hasn't taken out more than what she's allowed under the rider in this year. Withdrawal phase elected, that just means when she started taking withdrawals out of the annuity. And this is the current asset-based charge for the annuity, the M&E charge on it. Most annuities actually don't include that, just this company happens to do it. So when we're looking at income riders, there's two main types. We got the GMIB and the GLWB. GMIB is a guaranteed minimum income benefit. This rider is used a lot by the insurance company that uses Snoopy as their mascot, likes to fly blimps around sporting events. They're the primary company that really uses this rider. And it's got two options with it. Option one works just like the GLWB, which we're going to go over in just a second, but it basically allows you to withdraw up to 5% of that benefit base for life. So it's going to provide guaranteed lifetime income by taking 5% withdrawals out of the annuity. Option two, it will allow you to annuitize that benefit base for a slightly higher income. Now, I want everybody to understand this distinction. When you're withdrawing money out of the annuity under the GLWB feature, you're not annuitizing the annuity. Your annuity stays intact, all your cash value stays there. When you annuitize the annuity, you're turning over that money to the insurance company to receive a guaranteed income stream. Because you're turning that money over to the insurance company, you generally get higher income out of the annuity. The trade-off is you give up control of that money. The guaranteed lifetime withdrawal benefit is by far the most popular type of income rider that's out there. This rider, it allows the annuitant or owner to withdraw up to a guaranteed percent of the benefit base for life. And like we kind of went over, withdrawals do not equal annuitization. See, I got a question over when did LLIS start offering annuities? They brought me here 10 years ago because they were getting more requests than they could handle with the people here. So it has been, let's just say, probably, well, I know for a fact it's been at least 13 years for it, because in my prior life I used to be in a home office and provide low load annuities to LLIS. So they've been doing it for a while. So when looking at income riders, as we saw, there's two different values on the statement. There's the account value, that's the cash value. I call that the real money. Nancy's real money on that annuity was $968,941. Then she's got that benefit base. I call it the funny money. It was $982,600. So why do I call it the funny money? Well, let's take a look at this. So Nancy purchased her annuity. She put in $612,000 and she's guaranteed 5% growth. Whenever you have a client that tells you, I got an annuity and I'm guaranteed 5%, 7%, I've seen some 10%, that is not on the account value. That is all referring to the income rider. In fact, I just had an advisor today send me and ask me questions about an annuity. One of their clients was being proposed. They were being told they were going to earn 9.5% on the annuity. And we went over that. That's only on that income rider. So let's take a look at Nancy's annuity here. In 2013, she took out the annuity. Her annuity grew to that account value, $814,000. I'm sure any of us that were in the business back then remember 2013 was a gangbuster year in the market. So the annuity did very well. Her benefit base is guaranteed to grow by 5%. So it grew to $691,000. Now, one thing with these riders, they have what's referred to as a step-up feature. What that means is that on any policy anniversary, it could be monthly versary, it could be quarterly versary. There's an annuity out there that does it on a daily basis. But for simplicity reasons, and because most annuities are like this, on a policy anniversary, the annuity is going to do a double check. It's going to look what's greater, the benefit base or the account value. In this case, the account value is greater than the benefit base, so it's going to, benefit base is going to step up to equal the account value. So at the end of 2013, our account value and benefit base were both the same amount. 2014, another great year in the market. Annuity grows to $933,000. Benefit base by its 5% guaranteed growth grows to $854,000. Annuity does its check, and the benefit base steps up to the account value again. We go to 2015. Annuity grows to $968,000. Doesn't have as good a year. Benefit base grows by that 5% again, grows to $982,000. So Nancy, she's sitting there thinking, man, I sure would like to buy a condo on the beach. Nancy lives here in Florida. Having a condo on the beach, looking at a view like you're seeing there every day is great. So Nancy's like, well, I got $982,000 in my annuity. I can buy that condo. No, she can't. She can't use that 982. She only has the 968. Now, granted, in this example, the numbers are fairly close, but it's not uncommon for me to see annuities where the account value is, say, 150,000, and that benefit base may be 250,000. So there can be big differences in those. Some annuities are designed, especially when you start looking at the index annuities, some of them are designed to really only be used as income. And you'll see those big benefit bases and lower account values. All right, let's see, I got some questions here. So why does withdrawal not equal annuitization? So when you annuitize, so okay, let's look at it this way. Your client has $100,000 sitting in a bank account. They could take withdrawals from that money and take money out every year. Whatever is left in that account stays in the account. That's like a guaranteed lifetime withdrawal benefit. When you annuitize money, the insurance company is going to take that $100,000 from the client, stick it in the annuity, and give them a guaranteed income stream. They no longer have that $100,000 in their account. When it's sitting in their account, that $100,000 is in there. Let's say they take $5,000 out, a 5% withdrawal rate. They're left with $95,000. Next year, they can go, you know what? I'm going to take that other $95,000 and I'm going to go do something with it. When you annuitize something, you don't have that $95,000 sitting there anymore. It's in the insurance company's bank account because they're guaranteeing that income to the client. All right, so let's continue here. So what you'll see a lot of times with this guaranteed lifetime withdrawal benefit is you're going to have different percents that they can withdraw for life depending on how old they are when they take that first withdrawal. Very common to see something similar to this, maybe not every 5 years and maybe every 10 years you'll see a step up, but Nancy, who is 70, can take 5.5% for life based on that withdrawal. So when we go back to Nancy, year 3, her account value is $968,000. Her benefit base is $982,000. She's allowed to take 5.5% withdrawal, so she can take $54,000 for the rest of her life out of that annuity. Remember, you can't have both. You can't have the account value and you can't have the benefit base. So let's take a look at this, and this may help with the questions on annuitization versus withdrawals. So here we have our annuity, and we've kind of talked about these numbers already coming up to year 3. Account value is $968,000, $941. Benefit base is $982,600. So Nancy decides in year 4, I'm going to start taking income. So she's going to take the $54,000 a year. When you take withdrawals, it is subtracted dollar for dollar from that account value. So at the end of year 4, her account value goes down to $914,000. Benefit base stays the same. When you start taking withdrawals and you have an income rider, your guaranteed growth stops on that rider. If we look at year 5, Nancy takes another $54,000 out. So now she's taken a total of $108,000 out of the annuity. Account value goes down to $860,000. Benefit base stays the same. Nancy could say, hey, I want to surrender my annuity. She'll get $860,000. But what I want everybody to notice here, we go down to year 21. So Nancy is now 91 years old, and we're assuming no additional growth on this. We're keeping numbers simple. She's taken out her $54,000 again. She's received $972,000 of income at this point. Her account value is 0. Anybody, any client that comes into your office that has an annuity with an income rider and they want to keep the annuity, this should be their goal with the annuity, to be able to take income out under that rider and to deplete the value of the annuity. They want to get that annuity value to go down to 0. The reason for that, you look at year 22 plus, Nancy would continue to receive her income and she has no more account value in that annuity. It's not until that 21st year, all those fees Nancy has paid all these years for the annuity, it's only now in the 21st year the insurance company is on the hook. So I'm going to repeat that. Any client who has an annuity with an income rider, their goal should be to take withdrawals out of the annuity, to deplete it down to 0, to put the insurance company on the hook to continue to give them the money. So what does that mean? That means they should really start taking income out of their annuity products as soon as they are able to. They want to be able to live long enough to be able to withdraw the money out. Just because they wait 1 year to take withdrawals does not mean they're going to live an extra year on the end to get that money out. They should start taking withdrawals as soon as possible. All right. So with the guaranteed lifetime withdrawal benefit, I kind of talked about already, you have access to the money in that annuity. So what happens if Nancy withdraws more than her lifetime withdrawal amount? So let's say she wants to go out and be crazy, be the crazy old lady and buy the Lamborghini. See her driving down along the beach in Florida out here. She can do that. She can take money out. She's got her account value of $968,000. Let's say Nancy wants to withdraw half that money and go out and buy that Lamborghini. So she's going to withdraw $484,000 out of that annuity. When you take an excess withdrawal out of the annuity, it is going to reduce your account value dollar for dollar but it's also going to reduce that benefit base proportionally. So since we took 50% of that account value out, it's going to reduce that benefit base by 50%. So going back to our chart that we had here, in year 4, Nancy was originally going to start taking 54,000 out. No, we're going to change that. She's going to take 484,000 out. And you'll notice her benefit base and her account value both reduced by 50%. Now this is also going to reduce her future income. Instead of being able to take the 54,000, now she can only take the 27,000 for life out, and then that will continue as long as she lives. And once again, we want to get to that point where there's no money left in the annuity, so the insurance company is on the hook. So who should purchase guaranteed income riders? Well, it should obviously be someone who wants guaranteed income on these annuities. They have old annuities or life insurance that they no longer need or maybe want to start getting income from. They don't have time to recover if the market falls. With that rider, you're getting locked in. As we've seen, that benefit base stays locked in as long as we don't take out any more money than what we're supposed to. They want to lock in gains, and they want insurance on an equity position. That is what those riders really are. They're insurance on an equity position. If the market's going up, it's great. The rider's not doing much. But if we're in a down cycle in a market, that rider's going to keep growing by 5%, and their account value is going to keep going down due to market performance. And when they go to turn on the income, their income's based on that benefit base, not on that account value. All right, so before I move on to the next section, looks like we got some more questions coming in here. I need to figure out how to make this bigger so I can see more. Here we go. All right. Okay, so when you decide to annuitize an account and start taking the percent payout, is that an irreversible event? With a guaranteed lifetime withdrawal benefit like we were talking about with Nancy, no, you could start and take withdrawals whenever you want to. Okay. How can I get the slides? Claudia will be able to send those out. So generally for a client who wants income, it's better to start income sooner rather than later. However, if our client is within 6 months to 1 year until withdrawal percentage increases, does it make sense to wait to use the higher income percentage? That is a really good point. That is something you got to look at the annuity to see what the jump's going to be by waiting that little bit. But in most cases, yes, it would pay to wait to start taking that income if they're going to get a jump in that withdrawal percentage. All right, how common is the rider available for both the owner and the spouse? That just has to be selected at issue. All of them, I believe, I don't want to say all because I don't know off for sure, but pretty much every annuity that I've ever worked with does offer it to be done on a joint basis. How is the benefit basis reduced again? Flat 50% if I go over or based on additional percentage taken over guaranteed percentage. So how is the benefit reduced again by the 50%? Because Nancy took an excess withdrawal of 50% of the account value. So when you take out more than what you're allowed, it's going to reduce your benefit base by the same percentage. All right. All right, so let's move on. Let's talk about fixed deferred annuities. So what is a fixed deferred annuity? Well, they're great for clients that are tired of the volatility in the market. Because a fixed annuity, think of them as like a CD. You're going to get a guaranteed interest rate for a set period of time. Once again, because it's all fixed, we can lock in gains that they've achieved in other products or just in other accounts. The rates are guaranteed, and it can be a guaranteed inheritance for the beneficiaries. So here we have Mary Kay. Mary had 2 annuities. One was worth $325,000, one was $102,000. And what we did is we basically did kind of a laddered approach for her. We did a 6-year rate period, we took $90,000 of that money, got her an interest rate of 3.25. A 7-year annuity, 112,000. We did a second 7-year annuity for 112. We wanted to split the risk between 2 different companies. And we did a third annuity, 8 years, for $112,000 and got her a little higher interest rate. Now, this was done last year. Here are where current interest rates are today. The yield curve has gone fairly flat again. And if you haven't noticed, interest rates have actually been going down again this year, and there's talk of the Feds of possibly reducing rates 1 or 2 times this year. So, of course, that's going to have effect on all fixed products. And this is going to lead into my soapbox with annuities and interest rates. Interest rates kind of peaked back around 84 or so. I remember being a kid and my parents talking about CDs, getting 12% plus in it. And for my grandparents, that was a great way for them to retire and just live off the interest they were getting on their CDs. Now, as Claudia said, I have been in the insurance industry for 20 years. I've been working specifically with annuities for probably about the last 15, 16 years. All as I have ever heard is interest rates are low and they're going to go higher. Now, and I've posed this question several times when I'm actually out in front of people talking, giving a presentation. I'll ask, who tries to time the stock market? And I never see one hand go up. But yet, everybody tries to time interest rates. So the common saying is, why would I put something into a fixed rate when rates are just going to go up? Well, as we see since 84, they've gone nothing but down. When we did get a little bit of bump last year in rates, I heard the reverse. Well, why would I put anything in a fixed product when interest rates are just going up? So what I'm hearing from advisors is there's no right time to put money into a fixed product because everybody's always trying to time interest rates. So, and as we see, who would have thought rates would have been going down this year? But they are. Immediate annuities. This is my favorite annuity. To me, makes the most sense for clients when they are looking to get guaranteed income from an annuity. So here we have Nan. She's needs to get some guaranteed income, and they're wondering what they should look at for their parents. Well, first off, it's an immediate annuity. Does she really need guaranteed income? Do they have any old annuities or life insurance, especially life insurance that they no longer really need the death benefit for? Does she need income within the next 12 months? Immediate annuities, the income has to start within 12 months of that annuity being issued. Does she want to lock in gains from an existing product and start receiving income? Does she tend to be conservative? Generally, the type of people that are buying immediate annuities are more on the conservative side. They like the idea of receiving a guaranteed paycheck every year. For your clients, how I kind of talked about how when they're going into retirement, they've been saving. Some of them are reluctant or afraid to start taking money out of their portfolio. Buying an immediate annuity can help alleviate some of that fear for them when they start receiving that monthly paycheck again coming into their account. So how much guaranteed income should be purchased? What I always say is cover the basic bills that they're gonna have every single month. Cover that mortgage, cover the electricity, cover the water, cover the groceries, and they're gonna have other insurance premiums that they're gonna have every month. So make sure those are covered. Cover those fixed expenses that they're gonna have every month. Cover those with guaranteed income. Some of that's going to be Social Security, some of that's going to be pensions. If there's a gap there where they're coming up a little bit short, use an immediate annuity to cover that gap. It will give peace of mind to the clients. use the rest of the portfolio to give them quality of life in retirement. Use that money so they can go out and eat more often, travel, whatever it is they want to do. That's the fun part of retirement. Help them achieve that. Let them be at ease by giving them as much guaranteed income as they need. So which payout options? Immediate annuities have a variety of payout options. You can do a period certain, or we can do lifetime payments. Period certain are just like it says. It's for a set period of time. It could be anywhere from 5 years as long as 30 years. What's a common thing where they're used? You have a client who is 65, they want to wait till full retirement age before they turn on Social Security. A lot of times we'll look at using a period certain immediate annuity to cover that gap till they start taking full retirement benefits. What's nice with them, let's just say a client buys a 5-year period certain annuity, they pass away after 2 years, it's a guaranteed payout, so it's going to continue payments to the beneficiary of that annuity for those next 3 years, fulfilling that 5-year period certain. But a lot of times when we think of immediate annuities, we think of lifetime payouts. And you can do a straight life-only payout on an annuity, and that's going to give you the highest payout. It will pay for as long as the client's alive. Once they pass away, payments will stop. We can do guarantees on. We can do a life and a period certain payout. That can be anywhere from 5 to 20, maybe 30 years, depending on the insurance company and how young the clients are. But let's say they do a life and 10-year period certain. That annuity is going to make payments for either the 10 years or the life of that client. So let's say they purchased the annuity, they die after 8 years. The period certain part of that will continue to make payments to the beneficiary for the 2 years. Payments stop. The client lives to 10 years and 1 day and then dies. The period certain's been met. Payments will stop. Client lives for 30 years. Annuities can continue to be making payments under the life part of that. Life with installment refund and life with cash refund. These are my 2 favorite payment options because they guarantee that the annuity at a minimum is going to pay out the premium that was paid in. Makes clients feel like the insurance company is not going to win because someone's going to get at least the original premium they put in. So let's say the client puts in $100,000. They're receiving payments and they die after receiving $75,000 worth of payments. Under the installment refund option, payments will continue to the beneficiary until that other $25,000 has been paid out to fulfill the $100,000 original premium. The cash refund option would just write a check for $25,000 to the beneficiary in that case. And of course, since it's a lifetime, if they've received more than $100,000 in payments, doesn't matter. Annuity will continue to make payments to them as long as they are alive. And then you can also do these as a joint, and you have all those payment options available to you, and you could even do it where we could reduce payments upon the death of either the primary annuitant or secondary annuitant. Not used very often, but they are options that are available. So here we have Nan, who is 75. She's looking to put $250,000 into an annuity, and here's where payouts are at currently. Life only, 175. Life with 10-year certain, payments a little bit lower, and if we add installment refund on, it's a little bit lower yet. I always get asked, what are the interest rates on immediate annuities? I don't know. Insurance companies don't tell anybody what the interest rates are. But what I can do is I can do kind of like what's the rate of return to life expectancy. And this is what we have. Life expectancy for an Nan is about 14 years. For a female, that's 75. Life in 10-year certain is kind of like what a lot of people would go with. We can also add inflation onto these annuities. We can do an increasing payout option. There used to be CPI-U available. none of the companies we work with, and we work with, I think it's 15 companies for immediate annuities, none of them offer it anymore. Was never very popular, but you can do an increasing payout option. You can get anywhere from 1% to 5%. And that simply means every year that that monthly payment will increase by anywhere from 1 to 5%, whatever they select. 3% by far is the most common option used when someone's electing to have an increasing payout option. But of course, when we do anything, when we're adding on to an annuity, it's going to reduce the payments. So, but when looking at inflation, adding inflation to an immediate annuity, and I'm not a huge fan of doing this, as you can see, you're going to start off with lower income on the annuity, and we shouldn't be putting a majority of a client's assets into immediate annuity. Use the rest of the portfolio to hedge against inflation. Don't have the insurance company do it. And I'm going to show you why here. So here we have Ann, 75. We see the differences in payments. Actually, it takes about 9 years for that inflation adjusted payment to equal what she would have got. So she's going to be 84 years old before she's finally receiving the same amount a year as she would have if she had not added inflation on. Plus, she's received less income over those 9 years. But when we look at this, we look at the total amount paid out of the annuities, you can see even at year 9, obviously the level still has paid out more money. We actually got to go out 17 years, or Nan's age 91, which we're beyond her life expectancy at this point, to where the total cumulative amount paid out of both annuities is better to have the inflation option. So it's why I'm really not a fan of inflation option, because just the break-even point is so far out. Odds are against your clients living long enough to take advantage of that. Now, if they've got longevity in their family, they've lived a healthy life, it may be worth considering it. So a common question I get asked, should we wait to buy it? Every year a client gets older, the payouts are going to be a little bit higher on these annuities, but how much do rates have to increase for Nan to break even? If she bought it at 74, if she waited to age 80. So at age 75, payout would be for $100,000 premium would be $8,483. At age 80, the payment goes up to $10,608. It's a nice bump in the payment. It's actually a little over $2,000 higher a month, but she loses out on 5 years of income by waiting to buy the annuity. So she's out $42,000 by not buying that annuity then. And looking purely at this, her break-even point is at age 100. Assuming interest rates are exactly the same, nothing's changed, just thinking I'm going to wait to buy it because I'm going to get a higher payout. Not a good idea to do that. As we see, our break-even point's not out to age 100. We're way beyond her life expectancy at this point. But what about interest rates? So I had an actuary tell me that a 10% shift in the yield curve on a $100,000 premium, that's why I used $100,000 as an example, equals to a $60 change in the payout. So if the yield curve goes up 10%, that's be $60 more. If it goes down 0.1%, it'd be a reduction of $60. So the break even at age 85, interest rates would basically need to go up about 1.8% over those 5 years to break even, waiting to age 80, and then going out to life expectancy. So QLACs, Qualified Longevity Annuity Contracts. Some of you are maybe familiar with longevity annuities or deferred income annuities. Those two are both the same. QLAC is also the same thing, except it's designed for qualified money. So it's a qualified longevity annuity contract. It's a cross between a deferred annuity and an immediate annuity. Remember what I said, immediate annuities, you have to start payments within 12 months. With deferred income annuity, you have to defer the payments, typically at a minimum 2 years and could go out to possibly 30 years before you start turning on the income. These can be purchased with qualified funds, money that's not previously taxed. It's used as a supplement for retirement solutions, and you're getting a guaranteed payment stream. So let's look over the specifics on this. There are some restrictions on these annuities. So with a deferred income annuity, or a DIA as they're referred to, if you have qualified money, you have to start the income on those annuities by age 70 and a half, because that's when the IRS says you have to start taking your qualified money out. With a DIA, you can put in pretty much any amount you want into it. You just got to start taking the payments by 70 and a half. With a QLAC, you're able to defer those payments beyond age 70 and a half. So because of that, the IRS says we'll allow that, but we're going to limit it to 25% of the client's qualified assets, and up to a maximum of $130,000 can be put into this contract. And you cannot use any Roth money in it. And you can have a guaranteed income stream 20 to 30 years in the future, but you have to start your income by age 85. Income has to start by age 85. And they're only giving you 2 payout options to choose from: life only and life and a cash refund. You can add a death benefit onto it. What that basically means is if the client dies before payments begin, beneficiary is going to receive the original premium that was paid into the annuity. And this is why people do it. Why people like the QLACs, because the money that goes into it is excluded from RMD calculations. I see this annuity more of a tax play to reduce a client's RMDs they have to take every year than for the actual income stream they're going to receive at the end. So where I see clients and advisors using these, a lot of times it's not really until the client's 69, 70 years old. They're taking, to 25% or $130,000 of the client's money, putting it into these contracts to defer at least that amount, them having to take their RMDs on. So let's look at an example here. Here we have Adam, age 70 and a half. He has $500,000 sitting in a qualified account. He must start taking RMDs on the full $500,000. Under the new rules with these QLAC contracts, he can take $125,000 of that money, put it into the QLAC contract, and reduce the amount he takes RMDs on down to $375,000. So if you got clients, they're getting Social Security, they have pensions, they have all the income they need, they're paying enough taxes because of all that other income, and now they got to start taking RMDs, which is just increasing their taxes even more. Advisors like this as an option to help reduce that. I see this more of a tax play right now for clients. I know I'm getting questions. I want to make sure I get to the end of everything, and then I'm going to go back and answer all the questions. So to give you an idea, Adam's 70 and a half, $125,000. This is where the current payouts are with QLACs. So single life, if he starts payments at age 80, he'll get $1,278 a month. Age 85, $2,162. That is with the death benefit. You'll see if we do it without the death benefit, it's it is like a little over $500 more at age 80 that he would get by not adding the death benefit. But what that means is that if he dies before age 80, insurance company keeps all that money. A lot of clients are fine with that. They want to try to go for that higher payout. If we do like the single life with cash refund, you can see again what the payouts are. Not seeing too much of a difference with the death benefit. That's because a lot of companies automatically include death benefits with this option to start with. But there is a company out there or so that you can get the cash refund without a death benefit on it. So finally, I want to hit quickly on claims. So what happens when your clients come to you and say, hey, my mom, my father passed away, they have this annuity, what are my options? So we're going to use Jane here. So you got a couple options. One, you could take a lump sum. Jane will have to pay taxes on the gains, even though the annuities have a death benefit. It's not like a death benefit on a life insurance policy. The IRS wants their money on the money that's been deferred in an annuity. Excuse me. So Jane will have to pay taxes on all the gains, and she can do whatever she wants with that money. She's going to get it as a lump sum. Option 2, she can stretch those payments over 5 years. So withdrawals and gains will come with withdrawals, the gains will come out first. Or option B, she can annuitize over 5 years and spread those gains out over 5 years. And option 3, she can annuitize over her lifetime where gains are spread out over her life. So Jane inherited an annuity that was worth $260,000. $129,000 of that was cost basis. So Jane had to pay taxes on the gain of $130,000 if she did option 1. Option 2, she could take withdrawals. She could take $52,000 out a year. Year 1, it's 100% taxable. Year 2, it's 100% taxable. Year 3, she's finally taken all the gain out of the annuity. Of course, we're not taking any growth into account. And she's getting some of that out tax-free. Year 4, year 5 would be taken out tax-free. If someone was actually going to use this approach, I don't know why they wouldn't take out the remaining amount in year 3. But for illustrative purposes, we did it this way. If someone wants to do this, actually option B is a more common way to do it. Purchasing an immediate annuity with a 5-year period certain payout. They're going to get the same amount every year. Same amount's not going to be taxable, and the same amount will be taxable. So we're spreading those gains out over the 5 years. And thirdly, they can annuitize over their lifetime. So the first 25 years, they're going to have an exclusion ratio with this annuity. That's why we see non-taxable and taxable. That's just telling us what part's not taxable, which part of that payment's taxable. In that 26th year, we've got a little bit left of the cost basis, but once the cost basis has been removed from the annuity, it will all be taxable after that. So Jane's options was take the lump sum payment, pay taxes on the gain, do whatever she wants on money, stretch payments over 5 years, withdrawals, the gains will come out first, or annuitize over 5 years, spread those gains out over 5 years. And then 3, gains are spread out over lifetime. Jane actually went with option 2B in this case. So we covered income riders, fixed deferred annuities, immediate annuities, QLACs, and claims. You can come see me at all these conferences. I will be presenting at all of them this year. Hope to see some of you there. We do webinars every month. Next month is going to be advanced planning for business owners with disability insurance. I believe Kathy Bilodeau will be doing that one. But 10 things that make LLIS different are: 1, we're not your competition. Any of you that have worked with us, you know that. Our only clients are fee-only advisors. We don't have anybody under us. You'll probably have seen we try to do a lot of pre-underwriting before we're going to send quotes, or especially before we're going to submit an application to an insurance company. We want to make sure we're quoting as accurately as possible. We are sponsors of all these different organizations. We have specialists in all the product lines. I am your annuity specialist. I'm also considered a life specialist, as a lot of us here are. We help you with managing your clients' policies with different systems we have in place. And we have our portal, Alice, for you, where you can log in, see information on your clients, what we've done for them, where they are in the underwriting process on stuff. So we have all this stuff. Alice has been a great help to everybody. Advisors have absolutely loved it. They're able to get all kinds of information. All right, so I do have some questions here. How do they calculate when that lifetime rider can kick in? I have a client who, where does that go? I have a client who it appears it is available after 13 years. So it's going to depend on the annuity. Some annuities say you got to wait 10 years, some maybe 15 years. Some annuities, they don't really have a requirement how long you have to wait. That is done by contract. In the Lamborghini example, we're talking about the annuity for Nan. We are assuming that surrender penalty period is over. That was actually a no-load annuity, so it never had any surrender charges on it. What is a common charge for immediate lifetime payments? Um, I would say a common charge when you're looking at an income rider is going to be 1%. Some can be lower, some can be higher. It's all going to depend on how rich those riders are. So when you start seeing, oh, we're going to guarantee 7% growth on those, they're paying for it with a higher fee. With SPIAs, what's the best way to protect against inflation / cost of living increases? As I kind of said, with the SPIAs, I'm not a huge fan on inflation with those annuities. As advisors, you should be able to manage inflation with the rest of the portfolio. But if you're an advisor who doesn't manage money and you do more of one-time plans for clients, and it's up to them, it's okay to add inflation on in those situations. As we've seen, the break-even points are kind of beyond clients' life expectancies when inflation makes sense from a financial standpoint, but from a simplicity standpoint, it is a nice way to help protect the clients. Will you touch insurance company? I'm going to come back to that one. Do you buy QLACs within qualified accounts? Yes, that's what a QLAC is. It is only for qualified money. It is better than just paying the taxes on the money and reinvesting it back in the market. Not sure what that one means. You're still just deferring taxes on the qualified money placed in the QLAC. Correct. You are deferring the taxes on that. That is absolutely correct. But everybody's always trying to defer taxes as long as possible. It's amazing. We'll do reviews on life insurance. They'll have a $3,000 gain in the life insurance policy, and advisors want options so the client doesn't have to pay taxes on $3,000. So a lot of advisors don't want clients, or they want clients paying as little tax as possible. All right, how does LLIS work with advisors to help their clients? Would you be able to help us think through the best types of annuities for our clients' financial planning goals? Absolutely. We're here to work with clients to do planning. That's our jobs here. So if you have a specific need, give us a call, send us an email, and we'll work with you on that for your clients. So in scenario number 2, does the annuity still grow, or does it become static because the person's died? Usually in scenario 2, I didn't take growth into anything, but yes, the annuity would still be growing in those. I ignored all future growth when I was looking when income was starting on these annuities, just to keep numbers simple and so everything works out and looks nice and neat. Let's see, non-spousal inherited non-qualified annuity stretches most likely be less common in the Secure Act phase. Not sure what that means. That is one thing I didn't go over when inheriting an annuity. Clients might have the option to stretch the annuities, meaning they can take basically their RMD calculation out of that annuity every year. When you have a client, going back to our example, say the mother or father passes away, they have an annuity. First thing the client needs to do is notify the insurance company that the annuitant or the owner of that annuity has passed away. The insurance company is going to send them what's called a death claim kit, and that will actually outline all their options that they have. that that insurance company is going to offer to them. So what is the regulatory issue in regards to the percentage of assets allowed to be invested in annuities? Is this just common and usual practice? So it's not really a regulatory issue, it's an insurance company issue. Insurance companies don't like being sued by clients or beneficiaries of clients. So because of that, they've come up with what they call the 50% rule. You typically cannot put more than 50% of a client's investable assets into annuity. And that's just their rules. That is very common, especially with immediate annuities. They're not going to really budge too much from that, putting more than 50% of a client's assets into an annuity. If a client is looking for saving/investing, is it better to do so in an annuity rather than whole life insurance, assuming the insurance isn't needed? All right. We never ever really recommend using life insurance as an investment because of all the fees you have to run that investment dollars with. And a lot of times your break even is going to be farther out there. If someone wants to do that, we recommend using a low load life insurance policy to do that. We do have some low load universal life policies where they're able to earn an interest rate on it. And because they're low load, a lot of times that first year surrender value is going to be fairly closely equal to what the premium that was paid into it. And then we're talking about when we're overfunding those policies. So whenever you're using a life insurance as an investment, it should be overfunded almost to the maximum amount allowed, because then that minimizes those fixed costs in that policy, and they're become very small in comparison to what's going on with the rest of the policy. I was just asked that, does a QLAC really make that much a difference when you figure how low taxes are, then reinvest conservatively in the market? It seems like it wouldn't be worth it. That is for you as an advisor to calculate that. I don't do tax planning at all, but I can just tell you how other advisors have looked at the QLAC contracts. Secure Act Congress will be passing a bill reducing the stretch period to 10 years - possible 5 years on inherited IRAs. I'm assuming this will impact non-spousal stretch annuities as well. I would say yes. I have not seen anything on that yet, but I would agree with you. It should impact the annuities the same way. All right, so I had one other question I skipped. I want to cover that because it can get a little bit winded. Will I touch on insurance company default risk? So when an insurance company runs into financial troubles, there's kind of a step process that happens. So when they first run into financial trouble, and what happens the vast majority of the time, someone will buy that, another insurance company will buy that insurance company. That's what happens the vast majority of the times. When that does not happen, the state will step in, and then they will start trying to sell off the different books of business of that insurance company. So they'll try to find someone to buy the life insurance. They'll try to find someone to buy the annuity business. So that's the second step. The third phase, what happens if they're not able to get someone to buy them, someone to buy the books of business, the state will step in and run the insurance company. And that's where, if you've heard of the state insurance guarantee fund, that's where that comes in and backs up the policies up to what those policy limits are on those policies. So that's kind of what happens with it. The companies, before we work with them, they got to meet 3 criteria. They have to have an AM Best score of A or higher. They have to have a Comdex score of 80 or higher. And for those of you who are not familiar with what the Comdex score is, that's a score that takes into account all the scores or all the ratings the insurance company has from the various rating agencies, and it creates a percentile rating. ranking for the insurance company. So when we see a Comdex score of 80, that tells us that insurance company is in the top 20% of all insurance companies based on financial ratings. The vast majority of the companies that we work with are actually have a Comdex score of 90 or higher. There are some between the 80 and 90 range. And then thirdly, just because they have a good AM Best score, they meet our Comdex score. If their service hasn't been good, their underwriting hasn't been great, they've been difficult to work with, we won't recommend them either in that case. All right, that is all the questions I have. Thank you, everybody. This has been loads of fun. And if you have any questions, you can give me, there's my email address. I should have had that up there. I'm sorry if you don't know it by now. If not, just go to llis.com, look on the team, and you can get my email address that way also. Thank you, everybody, and have a good day.